Hi there. My name is Jonathan Dio. I'm the founder of Dio Wealth Management, the creator of the Happiness Dividend blog, and the Mindful Money Toolbox. Our last Mindful Money Minute video described and defined financial planning and laid out the elements of a good financial plan. Just to recap, those elements were understanding your current financial situation, knowing your lifetime of milestones, which included your lifetime retirement income, and then finally looking at some prioritization and making consciously designed trade-offs among the things that you want. Today we ask the question, how does a financial plan integrate with investing? One of the most important trade-offs people make in their financial plan is the more savings versus higher returns trade-off, or you could call this the risk-return trade-off. Take a look at how risk and return are related. Consider this chart. It's called the efficient frontier. You can see a return axis and a risk axis, and a blue line that describes the relationship between risk, measured in terms of volatility, or zigs and zags in the portfolio, and return. Perhaps it's obvious that the more zigs and zags you're willing to take in the short term, the more return you can expect in the long term. But also consider that the additional benefit of taking on additional risk seems to decline the more risk you take. This is often called the law of diminishing marginal returns. The more you can save from your income, the less return you will need and the less portfolio risk you have to take. Of course, if you model big returns into your plan, then you won't need to save nearly as much and you'll get to spend a lot more. But you'll have to endure larger zigs and zags in your portfolio, and if you don't get the returns you model in, your plans won't happen. Put simply, you can fill your portfolio in one of two ways. You can add to it from your income, or you can invest your savings and make those savings grow, or some combination of those two. The more you do of one, the less you have to do of the other. Before you start investing those college or retirement savings, you may answer a series of questions that suggest your risk tolerance is low. This basically means that you're only capable and willing to endure small zigs and zags in your portfolio before you panic and change your overall plan. This is what we're talking about when we discuss how an investing plan integrates with a financial plan. If I can't save enough, I may need to take more portfolio risk. When we look at risk tolerance and planning need, they almost always end up missing each other in this way. We all want to reduce our risk generally, and most of us have larger financial goals than our plan realistically will allow at the start. And this is where the final financial plan portfolio risk level trade-offs can begin. There are 4 ways you can close this gap. Save more today. This means earning more or spending less. Reduce future needs and expectations. Retire later or take more investment risk. If you do decide to take more risk, you realize that you must expect greater zigs and zags than you are normally comfortable with. And this can absolutely go against you if you panic at the wrong time. Be very careful making the decision to increase portfolio risk. It's almost always better in terms of increasing the probability of your plan outcomes to go with one of the other 3 options instead. I hope that helps you understand how to integrate financial planning and portfolio design. For now, just make sure you have a financial plan. Make sure it's steadily dollar cost averaging into the great companies of the United States and the world. And then worry about whether or not your kids are doing their homework well. And do an amazing job on that project at work, or start it on that stack of books that you intend to read. And then do something that makes you happy. Do something that matters most to you. Thanks for listening, and good luck.